It's time for another market update. In this video, we'll cover the recent market downturn and possible reasons behind it, the flashing of the SOM recession indicator, Bitcoin dominance, and more. So stay tuned. If you were watching the charts, you probably didn't miss the recent market nuke which happened a couple of weeks ago. From about mid-July, Bitcoin was leading a market rally, touching 70K and reigniting bullish sentiment before plummeting, wicking down to as low as 49K. Prices have recovered to around 60K levels at the time of shooting. Meanwhile, Bitcoin dominance reaches another milestone. In the latest dump, Bitcoin dominance rallied and finally broke out from the 55% level it's held for 15 weeks, while its price oscillated between roughly 50K to 70K. Remember, the Bitcoin dominance metric is not dependent on Bitcoin's price, but rather on its valuation relative to the altcoin market. Speaking of price action, however, Bitcoin just formed its first death cross of 2024, which is a technical indicator which indicates short to medium-term bearish momentum. It happens when Bitcoin's 50-day MA crosses below its 200-day MA. The last time Bitcoin experienced this was in September last year, though bearish momentum was short-lived then, as ETF excitement fueled Bitcoin's rise to new all-time highs. Nevertheless, at the time of shooting, Bitcoin dominance continues to climb, meaning that the collective altcoin market is still bleeding further against Bitcoin, regardless of its USD valuation. It's worth keeping an eye on this chart, at least every few weeks. This is because when Bitcoin dominance finally turns around, this could signal the true alt run which most traders and altcoin bag holders are waiting for.
This video is brought to you by Near.
Hey everyone, I'm Ilya, and I'm inviting everyone to Bangkok, November 9 to 11.
You've been duped into thinking anything decentralized was ever gonna work. There's a better way. Stop wasting your time with all this blockchain and go back to the norm. Get a latte and stop trying to change the world. Oh, and this thing in November, REDACTED, the hackathon, they're cushy office jobs out there, you know? Everything is working as it should.
For our special event, REDACTED. We're going to dive into AI, we're going to dive into Web3, chain abstraction, decentralization, and user-owner AI. I'll see you there.
Many different factors have been attributed as the cause of the market downturn, which affected markets globally. The most prominent of which having to do with the Bank of Japan hiking rates up by 25 basis points, the first hike in 17 years, in the face of rising wages and inflation in Japan. For context, prior to the hike, the short-term borrowing rate sat at just 0 to 0.1%. Analysts marked this hike as spelling the end of the popular Japanese yen carry trade. It's worth understanding the yen carry trade, as some analysts are predicting that last week's carnage may not be the end of it. Let's break it down simply. Essentially, the yen carry trade is where people borrow yen with little to no cost, then use that to buy assets outside Japan that yields, well, more than nothing, then earn a profit. These assets could be anything from foreign currencies yielding higher rates to equities or even crypto. The declining value of the yen also made the carry trade more lucrative, as loans became cheaper to pay off. Thus, when borrowing rates rose, many traders started to unwind their positions, whether it's to lock in gains or prevent losses. This in turn caused yen to spike in value against other currencies like the US dollar, since traders had to buy yen to repay their loans. Since this would make it more expensive to repay loans, this further causes a cascading effect where other traders are also incentivized to sell their assets to repay loans. Another reason for the market meltdown that people point to is the triggering of the SOM recession indicator, which has proven to be accurate historically. This could have spooked investors if they believe a recession is looming. However, it's worth noting that this time around, even Claudius Sohm, the creator of the indicator, admits that the indicator may not apply for the current market. But will this time really be different? Tensions in the Middle East also continue to rise, contributing to uncertainty and negative sentiment amongst investors and traders. However, others point out that despite the market-wide correction, the S&P is still up about 10% year-to-date, a better-than-average performance. Bitcoin, on the other hand, is up around 40% from its yearly open. Well, looks like that's about all the time we have for today, geckos. How do you feel about the markets? Did you buy the dip or think a recession is imminent? Let us know in the comments.